The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. Thank you so much for joining us today. My name is Jennifer Vivian, Manager of Entrepreneurial Services at the City of Brampton, and I'll be your host for this morning's Entrepreneurs Connect webinar on tax sense for small business. This session is hosted by the City of Brampton's Entrepreneur Centre. We are a partnership between the Province of Ontario and the City of Brampton, belonging to a network of 47 small business enterprise centres across Ontario that offers entrepreneurs various tools to start and grow their businesses. We are a one-stop source of resources that provides information, education, and access to services and programs that enable Brampton's entrepreneurs and small businesses to grow and thrive. I would like to pay special attention to our series partner this morning, MNP. Without their generous and ongoing support of our centre, event series like this would not be possible. MNP is a leading national accounting, tax, and business consulting firm committed to supporting Canadian business owners and communities. The firm created the MNP COVID Business Advice Center to provide timely insights and practical solutions to help organizations navigate uncertainty and adapt to the evolving landscape. Their experts across the country are closely monitoring the rapid changes to provide up-to-date content that is relevant to businesses and our communities. Before we begin, I'd like to go over a few housekeeping items. This webinar is being recorded and a copy will be made available on the City of Brampton's YouTube account. A link to the recording will be sent to you along with a copy of today's presentation. There will be time for Q&A at the end of the session. Everyone will remain muted, so please use the question box on your participant control panel to type in your questions. In the event we are unable to get to your question this morning, you are welcome to email us or the presenters directly. Their contact information will be available at the end of the presentation. It's a great pleasure for me to introduce our speakers today, who are going to speak to us about business structures and the important small business tax considerations for each. Jacob Angemeer is a Canadian tax partner working out of MNP's Mississauga office. Jacob specializes in estate and succession planning, working closely with business owners to develop strategies that best suit their short and long-term objectives. He also identifies other planning opportunities to optimally structure an organization's business activities to minimize their tax burden. Tushar Goel is a manager in the domestic tax group in MNP's Mississauga office. He works primarily with the private enterprise group to provide tax compliance and planning services to owner-managed corporations and high net worth individuals. Please join me in welcoming Jacob and Tushar.
Great, thanks, Jennifer. It's Jacob here, and thank you for inviting MNP to put on these series. And Tushar and I will be going through some topics regarding mainly focusing on business structures and whether it makes sense to incorporate and what the difference is between running a business yourself versus running a business through your corporation. So these are the two of us. As Jennifer mentioned, our contact info will be available at the end, so you don't have to rush and write this down, and you'll have access to this after the presentation as well. So as I mentioned, we're going to go through a number of different topics, but the focus through all of these topics will be the differences between running a business through yourself as a sole proprietor, which we'll go into in more detail, or running your business as a corporation, and the differences between each and the similarities as well. So we'll start with going through the related business structures and what they actually are. So there's three main types of business structures that you can choose. There's a sole proprietorship, a corporation, and a partnership. And there's other ones that are less common that can be chosen as well, but the two that we're focusing on in this presentation is the difference between a sole proprietorship and a corporation. A partnership, for tax purposes, is considered a flow-through entity. So essentially, whoever the partners of that partnership are, pay the tax. And those partners can be corporations or sole proprietors. So really, when you're making this decision, even if you are recommended to go in a partnership structure, you still have to make the decision whether it's going to be owned by yourself or a corporation. So these are really the two different structures that we want to consider and discuss in more detail. So a sole proprietor is a business that is not a separate legal entity. So it's, for example, Jacob Angemeer, myself, is running my own business under my own name, or maybe I have a operating name, but I don't create a company, I don't create a separate legal entity to run that business. And a sole proprietor can commingle kind of personal and business property because everything is owned by the business owner. There is no separate entity that owns the business assets. And we'll go through the taxation of this, but essentially a sole proprietor, you're taxed on your personal tax return because it's your personal income. A corporation, on the other hand, is a separate legal entity, and a corporation has shareholders that own the business. But the actual operations of the business are done by the corporation itself, not the shareholders. And whoever controls the business is usually whoever owns the shares of that company. So if it was just you're starting your own business, but you wanted to have it through a corporation, you would be likely the sole shareholder of that company and run your operations through that corporation. A corporation, as you'll see, provides a lot more flexibility. In one instance, you usually can choose your own year end. So what that means is when you're running as a sole proprietor, when you file your personal income tax return, it's on a calendar year basis. Comparing that to a corporation, you can choose any year end you want. So for example, you could have a year end in June. So you would report your activities from July 1st to June 30th every year. And it allows for some flexibility in tax planning, as well as if you have cyclicality to your business and there's a seasonality where you might be very busy at one time, perhaps you choose a year-end date where you're not as busy and you can focus on getting the books and records up to date and getting the tax returns filed at a time where you're not as busy. So we're going to go through a lot of this in a lot more detail going forward. This is just a general comparison of the two on one slide. So as I mentioned, an incorporated entity is a separate legal entity, whereas a sole proprietorship is not. One of the things we're not going to get into because this is more of a tax-focused presentation, but one major factor of incorporating is the legal liability aspect of it. If you run a business as a sole proprietor, it's just you. So anything that could potentially go wrong, someone sues the business, they're really suing you, not your company. So the company does provide an extra layer of protection from other personal assets that you may own. And it does get a bit complex, and there's certain liabilities that are not protected, and it's recommended that you seek legal advice to get more information on that. But generally speaking, a corporation will provide more legal protection than running a business as a sole proprietorship. As I mentioned, a sole proprietorship, you're paying tax on your personal income tax return at whatever your marginal tax rates are. So if you have a salary that you're earning and you also have your own business, you might be taxed at a higher rate because you're already using up your lower tax rates on your salary. Versus a corporation, you're taxed at various rates depending on the type of income that you earned. For business income, it ranges from 12.2% to 26.5%, which you can see is a much lower range than the personal income tax rates. And we'll get to the kind of the advantages and the reasons why you might want to incorporate shortly. And then there are some times the corporation rate can be as high as 50% on investment income. Of course, starting a corporation, you're starting a new legal entity. There's accounting and legal costs associated with that. It's going to cost you more to start it up. So the benefit has to outweigh that cost. Ownership, when you are operating as a sole proprietorship, you can't really sell your ownership interest in a sole proprietorship. You might be able to sell the goodwill or the client list that you've generated, but there's no shares to sell compared to a corporation. And other than these, we have kind of the operations of the business, HST requirements, and the income and expenses in terms of what you can deduct. There's really no major differences between the two different structures. And Tushar will go through some more of those in more detail. But I think that's important to note is that a lot of things are similar, whether or not you have a sole proprietorship or incorporation. It just depends on what makes sense for you. So I'm going to pass it over to Tushar, who's going to go through the taxation of business income. Just going to give him control of my screen. Okay, you should have control.
Thank you, Jacob. Good morning, everyone. As he mentioned, we'll now be talking about the taxation of business income. So the taxation of your business income really depends upon your business structure, whether that's a sole proprietorship or a corporation. And as we just discussed, both structures are subject to different tax rates. And you have to pay tax on your net income, which is calculated as the revenue that you earn by providing goods and services, less the expenses that you incur to earn that income. And this would have been covered more in detail in the bookkeeping webinar course last week, but you have to maintain financial records regardless of your business structure in order to calculate your accounting net income. You then have to calculate your taxable income by making adjustments to your accounting income for specific differences, which I'll cover in detail going forward. And once you figure out that taxable income, that is ultimately what you pay tax on. So a general rule of what you can claim as an expense against your taxable income, and this works for both accounting and tax, is asking if that expense was incurred for the purpose of generating income. And some examples listed here include your office supplies, such as paper and stationery, the cost of any physical goods that you're selling, salaries and benefits that you have paid to yourself and your employees, including any bonuses that were actually paid to those individuals within 180 days after your year end. Any amounts that you pay to your subcontractors, licenses and business dues, your business insurance, rent that you pay for operations, your utilities and telephone charges, as well as training events that you attend. So now we get into differences between treatment for certain expenses between accounting and tax, and what I mean by calculating your taxable income from your accounting income. So your golf club fees are never deductible for tax. So what you would have to do is add them back when calculating your taxable income. You can claim business portion of your auto expenses like fuel, insurance, repairs and license, and parking for business purposes only. And we'll cover auto expenses in more detail later. But what we mean by business portion is taking your total expenses for the vehicle that you've incurred for the year and prorating them based on the business kilometers you drove during the year relative to the total kilometers driven for that vehicle. And you can claim home office expenses, which is a hot topic right now, given how many people are working from home. For individual sole proprietors, you have to meet the criteria of regularly meeting clients at your home office, or that place has to be your principal place of business in order to claim these home office expenses. And for a corporation, if you do choose to incorporate, your corporation can claim your home office expenses as a rental charge to the shareholder against their shareholder loan balance. Now, what this means is that the corporation claims the expense, and that portion is owed to the shareholder at the end of the year because the shareholder paid for that expense personally. And to further explain what we mean by business use of home office expenses, and this is regardless of your business structure, is that you take the total of your home expenses, including repairs, property taxes, utilities, and you prorate that amount over the square footage of your home office versus the total square footage of your residence. That's the most common method that we see of calculating home office expenses. Now for meals and entertainment, you have to add back 50% of those expenses when calculating your taxable income. And it's very important that when you are maintaining your books and doing your bookkeeping, is that you separate these expenses out from your general advertising expenses so you can figure out the add back amount. You can, however, claim 100% of meals and entertainment costs as long as you have events that are available to all staff members during the year, but only for up to 6 such events during the year. And for any fees that you incur to obtain loans and any other forms of financing, what you have to do is add back the entire amount of that fees when you're calculating your taxable income. And instead, what you do is claim it over 5 years instead, or you can think of it as 20% per year of the total expense. And something that's not on the slide, but you should know, is that if you actually repay the loan before the 5-year period, what you can do is deduct the remaining fees at that time. Now, I know we talked about auto expenses before briefly, but now we'll talk about it a bit more in detail. So as a sole proprietor, what you have to do is track all your auto expenses with receipts and a logbook to figure out what your business mileage was relative to the total mileage during the year. And you can then claim your allowable auto expenses by prorating them using the business kilometers driven. Now, in a corporation, if the shareholder or employee owns the car personally, they are entitled to a per kilometer allowance, which can then be claimed by the corporation as an expense and is not taxable to the vehicle owner. Now, for 2020, this reasonable allowance is calculated as 59 cents for the first 5,000 kilometers and 53 cents for every additional kilometer driven. And when I say kilometers, I'm talking about the business kilometers here. But it should be noted that these amounts, so the 59 cents and the 53 cents, so these two amounts actually include HST, and the corporation can claim that portion as an input tax credit if it is registered for HST. Now, what we should also note is that if your vehicle is owned by the corporation, yes, the corporation can claim the related the relevant expenses when doing the corporate tax return. However, any person-related mileage that the corporation pays for, that actually becomes a taxable benefit to the person driving the car. And what we want to stress in our presentation for auto expenses is that when we see CRA sending letters looking to verify auto expense claims by either sole proprietor or a corporation, you always have to provide a logbook, and you should always be maintaining a logbook that details the business trips taken during the year, the purpose of the trip, and your business kilometers driven. Now, this doesn't necessarily have to be a paper log. It can even be done using an app on your phone or some sort of spreadsheet that you made yourself. I'm sure that if you Google, you'll find tons of examples of driving logs that you can use. Now, moving on to due dates for making tax payments to the CRA. So corporation has to pay the tax either 2 or 3 months after the year end, which we will talk about later when discussing the small business deduction. And when you do claim the small business deduction, you can get that additional month. And the actual corporate tax return has to be filed within 6 months after your year end. This means that the tax may have to be estimated and remitted before the corporate tax return has been filed. Now, for an individual sole proprietor, they have to pay the tax by April 30th, just like any individual filing their tax return, whether they can just be a regular employee. The tax is still due on April 30th. They can, however, file the tax return by June 15th instead of April 30th. And you should note that this extended deadline also applies to spouses of sole proprietors. The tax still has to be paid by April 30th, though, for that spouse who's not a sole proprietor themselves. Now, to assist business owners with not having to pay a large tax bill at the payment deadline time, now CRA requires that installments be paid throughout the year if your final tax liability for the year before exceeded $3,000. So what this means is that for both individuals and corporations, CRA does a pretty good job of sending installment reminders before those payments are due throughout the year. Therefore, you prepay that estimated tax throughout the year, and this should ideally help you avoid cash flow issues when it's time to make the final payment to the CRA. So now, depending on your business structure, you have to pay tax at the different tax rates in Ontario. And this was covered before by Jacob in that chart. Now, in a corporation, once we have calculated our taxable income that we discussed earlier, on the first $500,000 of business income, you are entitled to something called the small business deduction. And the tax rate on that income is 12.2%. And this includes both the federal and provincial components. Now, for business income that you earn in excess of $500,000, the high general tax rate applies of 26.5% in Ontario. And if your corporation is earning investment income, so that means the rent, interest income, royalties, etc., now that income is taxed at the tax rate of 50.17%. And it should be noted that the effective tax rate on investment income in a corporation is actually 19.5% once the corporation has paid a taxable dividend to their shareholders in order to recover the refundable portion of that 50.17% tax rate. And for this webinar, however, we won't be discussing the mechanics of refundable tax in detail, but it's still something to know. Now, The tax rates provided for corporate income here are strictly limited to the corporate income only, which means that your individual shareholder still has to pay income tax when those after-tax funds in the corporation are extracted by them. And we'll talk about how we can do that later in this presentation. Now, if you're a sole proprietor, what they have to do is they have to pay tax at their personal marginal tax rates. In Ontario, this combined marginal tax rate can vary between 20.05% and 53.53%. And that really depends on your total taxable income earned during the year in order to figure out what tax bracket you're in. And the sole proprietor is liable to pay both the employer and employee portion of CPP on that self-employment income earned during the year. Now, we presented the different tax rates here, but what we want you to take away from this webinar for this is that once a business owner extracts money from their corporation, how our tax system is designed is that there should be no difference between earning that income personally or as a sole proprietor. And this concept is called integration, which Jacob will cover in greater detail going forward.
Okay, thanks, Tushar. A question just came up, and I'll just answer it quickly since it has to do with Tushar's section. Can you claim expenses if you have sales representatives outside of Canada in a foreign country? So I think that the answer is yes. I think it still comes down to the test of, are you incurring those expenses to earn income? So if your sales representative is selling services or goods that you're paying tax on in Canada, you're getting income from it, or you have the potential to get income from it, then those expenses, regardless of whether they're spent in Canada or outside Canada, should still be deductible. Obviously, there's exceptions sometimes depending on the expenses, but generally speaking, if it's earned or if it's incurred in order to earn business income, you should be okay. And I just got another one. So before I start, is rental income considered investment income? Generally, yes. Unless you have a large operation with more than 5 full-time employees, you're going to be paying that higher 50% rate on the rental income. Okay, so I'll go through this concept of integration in more detail, and this is really the meat of the presentation in terms of whether or not you should incorporate and whether it makes sense for you to do so. So there's a bunch of rates on this, and this gets a bit confusing sometimes. I'm going to go through kind of one by one, and then I'll show some examples as well. So the corporate tax rate we talked about, on the first 500,000, you're paying tax at 12.2%, and then on the remainder, 26.5% in the company. This second row, the flow-through rate, so this is what Tushar mentioned. After you pay the corporate tax, if you want to take that money out to spend personally for personal use, you have to pay a layer of personal tax as well. You can't just take that money out with no further tax. So the flow-through rate is the total amount of tax that you'd pay if you first pay the corporate tax, then take it out as a dividend and pay personal tax. So you can see it's 54.12% or 55% on the general income. These rates are all at the top marginal rate. So once you're earning over $220,000 personally, the same concept applies as you go through the tax brackets. We've just picked the top one to show for illustration purposes, but the same concept applies. So what we've done here is compare that flow-through rate to earning the money in the corporation and paying yourself a dividend to, had you been a sole proprietor and just earned that money personally, what would you have paid? And in this case, that's the 53.53% top rate. So if we skip down to the last row, you can see that the difference between the two is pretty small. We're less than 2% difference in terms of earning money through the corporation and paying it out versus earning it as a sole proprietor. The key here is this tax deferral line. So if you don't need the money personally, there's a 41.33% deferral of the taxes that you're paying because you're only paying 12% up front. So for like, as an example, if you earn $100 in your company, you're only paying $12 of tax, and you have $88 left over to reinvest in your business or reinvest in something else in the company if you don't need to take that money out for personal consumption. Versus if you had run that as a sole proprietor, again, just assuming the top rate for illustration purposes, if you earn $100, you're only left with $46, $47 to reinvest in your business. So the great advantage there is if you don't need the money personally, there's a huge deferral available, especially for the first $500,000 of income at 41%. But even if you're subject to the higher rate in the corporation, you still have a 27% deferral. So this could be something, especially if you're just starting out a business and you may have a salary personally, which already gets you to a pretty high tax bracket. This deferral could be a big advantage if you don't need to take the money out. So this sort of just reiterates exactly what I've said, and I just want to say the last point again because it's important. A lot of people jump to incorporating a company because you hear, oh, corporation, I can get write-offs, I can get tax savings. The real advantage is the deferral. So if you incorporate, as Tushar went through, you can essentially deduct the same amount of expenses as you could as a sole proprietor. The real advantage is that deferral of leaving the money in the company. So if your plan is to run your business and take all the money out and spend it on your personal needs, then maybe incorporating isn't for you, at least from a tax perspective. There could be legal reasons, liability reasons, like I mentioned briefly, that it still makes sense to have a corporate entity. But from a tax perspective, it's really that deferral that is the key advantage to having the income being earned in a corporation versus a sole proprietor. On top of the legal liability, there's compliance costs associated with a corporate tax return. There's additional bookkeeping requirements, legal minute requirements in terms of just maintaining the corporate books and records. It's much simpler, as I mentioned, to run a sole proprietor. You might register for a business name or a business license in Ontario every 5 years, and that's kind of the extent of what you need to do, which might cost you $50 or $60 every 5 years. And then your personal tax return will be a bit more complex because you have your business income, but it's not the same level of complexity as having a separate legal entity. Two other things to consider, other than the tax considerations, is the simplicity of your operations. What I find is kind of the bigger your operation is, the more likely it is that incorporating makes sense regardless of the tax reasons. If you're dealing with larger suppliers or larger customers, a lot of the times they prefer to either sell or buy from a corporate entity versus from Jacob Angemeer, for example. So just having that corporate name with an ink at the end might help you in terms of just reputation or reliability in the marketplace. So that could be a major factor. A lot of foreign companies, like US entities, will only deal with a corporation. So that could be a consideration. And the last point is the saleability of your business. If you're not aware, there's something called a capital gains exemption, where it's roughly if you sell the shares of a company that qualify, that's an active business in Canada, there's various criteria that have to be met. But if you meet those criteria, up to $880,000 of your sale of the shares can be received tax-free. So that's a big advantage that you can only get by having a corporation. If you run a sole proprietor, there is planning involved that you can kind of create a corporation and transfer your business in, but it might be simpler from the get-go if you already have a plan to sell your business and sell the shares of your business. It might make sense to have a corporation to access that capital gains exemption and potentially multiply it with family members. So as I mentioned, it is a little bit more complex to run a company or business through a corporation. When you run it as a sole proprietor, all the money is yours. So you're going to pay tax at whatever your marginal tax rate is on your personal tax return, but then you don't have to worry about it anymore. That money is your money. You don't have to worry about the second level of taxation. for a corporation, every year you have to kind of reconcile the books in terms of how much money did you take out of the company versus what have you declared as a salary or as a dividend, and essentially those numbers have to reconcile so that you've paid tax on all the money that you've taken out from the company for personal use. So this example is sort of something you'd have to go through every year to take a look at and some planning. So in this example, let's say you've taken $200,000 out from your company. 20,000 of it was used to pay business expenses. So you paid the business expenses personally. The company gets to repay you that money tax-free without having to worry about the personal tax on it. $100,000 was net salary, so after taxes and CPP was paid to the shareholder. So if we take the $200,000 we've taken out, 100,000 of it has already been taxed as salary. 20,000 is tax-free business expense reimbursement. So we're left with $80,000 extra that we've taken out that we haven't paid tax on. Typically what we do in this situation is this is where dividends come into play, where the amount remaining that you haven't paid tax on has to be taxed as a dividend. And every year before February 28th of the next year, so for example, if I had taken out this $80,000 this year, by February 2021, the company has to file a T4A Slip to declare that the company has paid you $80,000 of dividends over the last year. Typically, this example is simplified. Typically, there's a lot of other considerations. Does it make sense to pay a dividend? Does it make sense to bonus the amount out? There's various considerations, and your accountant should be able to help you out with this if you have questions. It's sort of something we do with our clients as part of our year-end planning when we take a look at the books and we decide kind of what makes the most sense for the particular situation. Unfortunately, it's not as simple as there's a golden rule that there's just one answer for. It does depend on the situation. But typically in this kind of simplified example, this is what we would do is pay a dividend to clear out the excess amount that has been taken out that we haven't paid our personal tax on. So the topic of personal service businesses is something I wanted to cover because this can get individuals into a lot of trouble from a tax perspective. So I just want to make sure that everybody's aware of it and to try and not get yourself into this situation. So the definition of personal service businesses is a business that a corporation carries on to provide services to another entity that an officer or employee of that entity would usually perform. So I think the easiest example of this is if you're currently employed full-time, you have a T4 from that company, you work 40 hours a week, you have benefits, kind of all the normal things that a vacation time, everything that an employee has, and you decide tomorrow that you're going to open up a corporation and your employer is now going to pay you through that company. This is exactly what these rules are trying to prevent. If you haven't changed the nature of your relationship with your employer, you're still an employee even though you've incorporated. So these rules will kick in to prevent people who would otherwise be considered employees to just incorporate a business. And so if you fall into these rules, I'm not going to go into it in a lot of detail, but essentially you're taxed at a very punitive rate and you're restricted in terms of what sort of deductions you can claim against your income. So you're pretty much treated as if you're an employee or worse. So it's not something you want to get into. And there's potential solutions, but in the example I provided where you're an employee today and you're a corporation tomorrow with no change in the business relationship, that's where you're going to fall into these rules and get caught. So what do we want to do to get out of this situation and make sure that perhaps if you are running a business through a company and you only have one client that could be considered your employer, what do we want to look at to help make sure that we have good facts to support the fact that you are not an employee, you are independent of that employer or that business. A contract helps. Just because a contract says that you're not an employee doesn't mean that the CRA is going to agree, but the intention of the two parties does help. And without a contract, it makes it hard to argue that that was the intention. So it's always a good idea to have a contractor agreement with whoever you're dealing with from out of your corporation. They also look at various factors such as the control of the work, whether you have ownership of kind of the tools or equipment you need to do the job. Are you risking anything? And how integrated are you into that client? So do you have an office there? Do you have an email address at this place? Do you have characteristics that are more like an employee compared to someone who's self-employed? So if you think you fall into one of these situations, I'd highly recommend asking help from an advisor and just making sure you're protected as much as possible to make sure you don't fall into this situation, because this is not a situation you want to be in with CRA, and you want to make sure that you have the good facts in order to back up your position that you are independent of whoever you're providing the services for. And just, I don't want to scare people. If you've started your own business and you have customers and you're selling to customers, you may sell a lot to just one customer, especially when you're starting out. There's no issues with that at all. This is really trying to just capture the people who should be employees of that company. And just some other miscellaneous points just to consider when dealing with a business. If you have employees, you're paying them salary and you're going to have to pay payroll remittances every time you pay them, so you're paying them a net paycheck. And you also have to file T4s by February 28th. And a question came up about the T5 filing deadline. That February 28th deadline for T4s and T5s is fixed. It's a calendar reporting basis regardless of the fiscal year end of the company. So that's always a February 28th deadline no matter what. And if you have contractors, if they're registered for HST, you may pay them HST on top of the contractor fee, but you don't file T4s for that. And just some other notes, as I mentioned, if you're paying employees, you have to consider remitting CPP and employer insurance. If you have payroll, if you're large enough to have payroll over 490,000 in Ontario, there's also employer health tax to consider. And also WSIB premiums. If you have employees other than yourself, chances are you're going to have to pay WSIB, even if it's just an office job. There is a rate for that has to be paid as well. All of this, once you start getting employees more than just yourself, it's usually a good idea to look into a payroll service provider or something like Ty may have talked to you about this last week if you were on that session, kind of our ease bookkeeping service that we have. It would help do the payroll, some sort of service that helps kind of manage this all for you so that you can focus on your business. And last few housekeeping points, just a couple slides here. That in order to keep proper books and records with CRA, you do have to keep them for at least 6 years after the end of the year. They can be electronic, but they do have to be kept and stored in case CRA asks. And a common question we get is, should you hire a bookkeeper? Again, this was probably covered more in last week's session. I think there's a level of activity where when you start feeling that the amount of activity that's going on in your business, you're getting overwhelmed, it's getting too much to handle on your own, and it's taking away from you focusing on your business and earning income for your business, that's probably when it makes sense to start thinking about getting someone to help out with the bookkeeping. Even if it's just once a month, once a quarter, depending on the level of transactions. Something to kind of take it off your mind and make sure that you have someone that's doing it right, and it's one less worry for you at year end if you have all the books and records all together. So in terms of getting ready for year end, a lot of companies have December year ends, which we're creeping up on already. Just an example of things that your accountant may want to see if they're filing your tax return. If it's a new company and you've decided to incorporate, the articles of incorporation provide detailed information about the structure of a company, so the accountant will want to see that. Internal financial statements. So if you have a bookkeeper or you're doing the bookkeeping yourself, you'll have financial statements to provide them. A detailed general ledger, which shows all the transactions that happen in the year. Information about specific expenses that you're claiming, such as home office, your vehicle log for business, mileage, payroll information. Did you buy or sell anything outside of your normal course of business? For example, did you buy equipment during the year? Bank statements, loan statements, any letters from CRA that you've received, and amounts you paid in taxes. Essentially just a recap of everything that's happened in the year, so that your accountant or your bookkeeper knows what happened, what's going on, and kind of minimizes the amount of questions and the back and forth at year end. So I have this last section on GST and HST. I want to leave some time for questions, so I'm just going to go through it pretty quickly, just at high level, because GST and HST is more, it's applicable whether you're a sole proprietor or a corporation. The rules are the same. You will have access to these slides if you want to go through them. I'll just go through sort of the basics of it in the first two slides, and then we'll move on to questions. So generally, if you're providing goods or services, you have to charge HST, generally speaking, and you collect that HST on behalf of the government, and you can reduce that amount by whatever HST you pay on your expenses. So every time you file an HST return, you take your HST that you've collected, and then you subtract any HST you paid, and that's what you owe to CRA when you file your return. And the last thing I'll cover is just the exemption. So there's this $30,000 threshold. So if you're earning less than $30,000 of revenue in a year or over the last 4 consecutive quarters, you have to register. There's no choice. You have to start charging the HST as soon as you get over that $30,000 threshold. You can choose to register from day one, and sometimes that's beneficial because you can claim the HST that you're paying against the HST that you're collecting. So if you know that you're going to be over that 30,000 anyway at some point, it might make sense to just start from the beginning, get the benefit of claiming the HST back. So I'm going to skip to the end. Again, these slides are all available if you want to read more about the HST. I wanted to focus more on the differences between the corporation and the sole proprietor. So I do have one more question here that I'll answer, and then we can open it up to any remaining questions. So one question is, can you briefly tell some advantages of bonuses over dividends? So there's a few differences between them. From a bonus perspective, it's considered salary, so it adds to your RRSP room if you're contributing to an RRSP. You do have to pay CPP on that bonus if you haven't already reached the maximum, so there is an additional cost to paying the bonus. Versus a dividend, there's no CPP, but you don't get RRSP room. Typically, when you've taken money out over the year and you haven't already paid yourself a salary, the easiest way to clear that problem so you don't have an overdraw that you haven't paid tax on is to pay a dividend. But it does depend on the situation, but essentially, as we went through kind of the integration, the tax rates are pretty much the same when you consider that a bonus, you get a deduction in the company. So you're paying more personal tax, but you're paying less corporate tax. The dividend, you're paying less personal tax because you've already paid corporate tax.
Great. Jacob, I can add on to this question as well, since we get
Sure.
this question a lot. So for more mature corporations, what we sometimes do is we notice that a bonus can actually get you down to the small business rate that we discussed earlier if your business income exceeds $500,000. Remember how we talked about that if it's within $500,000, you have a lower corporate tax rate because of that small business deduction. What we can do is bonus to the shareholder to get that taxable income down, because you can claim the bonus as a deduction. But this, once again, like Jacob mentioned, this means that the individual has to then pay personal tax on that bonus.
Okay, I'll just keep going through these questions here. Tushar, can you see the questions as well?
I don't.
Okay, I'll read it out here. So the next one is, if a corporation has hired a contractor, how are the contractor fees paid to the contractor considered? Do you want to take that one?
Sure. So like before we talked about when you're calculating your net income, and now this counts for both accounting and tax, is that you can actually claim that as a subcontractor expense. The only thing that you have to be careful about is, like Jacob talked about earlier, is make sure that they are actually contractors and not like and they can't be treated like your employees if the government were to come in and look at that relationship.
And so for employees, you have to file a T4 slip. For contractors, you technically have to file a T4A slip, but CRA's administrative position on that is that you don't necessarily have to. They don't charge penalties for not filing them, but they technically are required. But if you haven't been doing that, I wouldn't worry about it because they've stated on their website that they won't charge any penalties for not filing. The next one is, so if I've just started my business and I'm not earning $30,000, I don't have to charge taxes on my goods. So that's correct, as long as you haven't registered for HST. So as soon as you register, it doesn't matter if you're over the 30,000 or not, you have to charge it because you're registered for HST. So if you've decided not to register because you're not earning the $30,000 of revenue in a year, then you don't have to charge it. As soon as you register, now you're required to, regardless of what you're earning. Next question is, for the service businesses selling in a foreign country, should the Corporation of Ontario charge the client HST or GST? So generally speaking, if you're providing services to someone who has an address outside of Canada, you don't have to charge the HST, but there's so many exceptions and so different exceptions to the rule, and depending on the exact type of service you're provided, I'd recommend to ask a professional advisor for more information just to make sure that you're on side. But generally speaking, you don't have to charge it. The next question is, can a director be a contractor of the corp and not an employee? So this is something we see quite often. It's not recommended. CRA's position is very clear that if you're a director of a company, you are considered an employee. So you shouldn't be paying kind of contractor fees to a director of the company. You should be paying a salary or a dividend. There's a lot of tax issues you can get into by paying the contractor fee. There's HST issues, if you should be charging HST on those fees. If you're not remitting CPP or withholding tax, and CRA comes back and says it's a salary. The reality is that if the director is also the shareholder of the company, you're not losing any money by treating this person as an employee. It's a bit more of a hassle because you have to pay the required remittances when you pay the salary. But I think it'll save you a lot of headache should CRA look into it. We always recommend, and if we have a new client who's been doing this, we always recommend to switch and start paying the directors or shareholders as an employee a salary, or pay them a dividend.
Great. Thank you so much, Jacob and Tushar. I know that there might be a few more questions, and we definitely still have time. So just a reminder, please use the question control panel to type in your questions. If you are not comfortable asking them over the platform, you're welcome to email us or email the presenters directly. They'd be happy to get back to you. And we'll just give it a couple more minutes and see if anything else comes in.
Sure.
I guess while we're waiting, just as a friendly reminder, we will be sharing the recording, a link to the recording. So if there's something that you need to go back to, or if maybe you know someone that was unable to join us today, please feel free to share that recording link with them. There is a copy of the presentation that's been uploaded to the handouts section of the control panel. So you're welcome to download a copy here, or you can wait for our email later this afternoon. We will be sending you a copy of the presentation.
Okay, we got another question that came in. What should you look for when hiring an accountant? Great question. So, and I guess the follow-up to that was, and do I have to hire one as a new and small business? So, what I think of an accountant is really someone that's there to kind of, well, one, make sure that you're kind of complying with all the various rules in terms of accounting and tax requirements and filing deadlines. But they're also there to kind of be a trusted advisor, someone that you can go to for advice, someone you can ask questions to, someone you can talk to about potential planning opportunities. Are you, for example, should you incorporate? Should you run it as a sole proprietor? So that's sort of someone who is knowledgeable about those areas, someone that kind of gives you confidence when you're talking to them initially. And I think at the same time, you kind of hope that when looking for an accountant, that this is a long-term relationship. They're going to grow with you as you grow your business. So it should ideally be someone you get along with as well, and someone that you kind of look forward to talking to and not being a hassle every year to deal with your accountant. So that's, I think, the most important, two important things is make sure that they're knowledgeable and they kind of have a good breadth of experience, and also that your personality gets along with theirs as well. And the second part of your question, do you have to hire one? Not necessarily. I'd say if you have a corporation, it does get pretty complex to kind of navigate the corporate tax return and file it on your own. There are people that do that, and you're kind of more than welcome to go through that process. But it is more complicated than filling out a business income statement form on your personal tax return. And I think that there's a lot of things that you may not consider in terms of just additional deductions or things that you might not have thought you could claim, that the price of paying for an accountant may be worth it just for those kind of extra pieces of advice that you might get by going through it. And then you have the peace of mind that it's done right from the beginning, and you don't have a kind of a problem later on with CRA. Next question is, are you taking on new customers? If so, are you familiar with charities as well? So definitely, we're happy to talk to anyone who's interested if you're looking for a new accountant or just starting up your business. Charities, yes, I kind of on the tax side, I deal with them, and we also have audit partners here who deal with, if you're a registered charity, you normally have to have a financial statement audit as well. So we have partners in our office here that are well versed in that and deal with many charities kind of across Ontario and locally as well. So definitely something we have the experience with, and I can put you in contact with the right person if you wanted to reach out. Got our contact information on the screen here. Okay, another one just came in. For example, if your business is registered under clothing and jewelry retail, can you add the importation of international food? Yeah, so there's no requirement to just do one thing. So if you're a corporation, the corporation can have many different businesses. I think it's more of a legal question if you want to combine those businesses into one company or have a separate company. Just remember that it's one entity. So even if you have two separate businesses, potential creditors could come after the other business because it's contained in the same one. So sometimes two unrelated businesses may make sense to have in two separate companies. So it does depend, but there's nothing stopping you from doing so. And as a sole proprietor, same thing. You could have two sole proprietorships going on. You might need two separate business licenses if you're using two different names. But again, nothing stopping you from doing more than one type of business in the same entity.
Great, thanks, Jacob. We'll just give it another minute or so. Looks like there's a few more questions that are coming in.
Okay. Okay, next one here is I opened a small home sewing business about 3 years ago and got a business license, but I never filed tax for this small business since I didn't earn a lot. I earned around 500 or less than 1,000. My earnings is not steady. What should I do? So the business license, that's more like for a sole proprietor. So there's no kind of any income that you earn will be reported on your personal tax return. If you're earning kind of less than $1,000, $500, and your costs to kind of keep that business running. So if you operate out of your home and you have home office related expenses and they kind of offset the income you're earning, like technically there's a requirement for any dollar you earn to pay tax on it, report it to CRA. But CRA has said that if the business is more of a hobby in nature and it's not really, you're not really doing it to earn income, and if you have more expenses than you have income, then you shouldn't be reporting a loss on your return. If you have a net income, so your expenses aren't as much as your income, then you should technically be reporting it. But what I would do is just kind of keep track of it going forward, and if it starts growing and you end up earning more than your expenses are to run the business, then I would start reporting it on your personal tax return. Because it's sort of stopped becoming a hobby and now become a business that you're earning money from. But from before, as long as you can substantiate that you have an overall loss with your revenue minus expenses, then I think you're okay. Next one, is it easy to change the name of my corporation if I am doing a personal service different from the original intent? So to change the name of a corporation, you have to file articles of amendment with the Ministry of Ontario or with the Canadian government, depending on where your corporation's incorporated. It's a fairly simple process. It's probably going to cost you between $500 and $1,000 to do so. So it's simple process, but not cheap. So there is a fee every time you change the name of a corporation. An alternative is you may have a name of your company, but you're operating as a different name. You could always get a business license to operate as that name. So the legal name of your company doesn't change, but you're registered to operate under a different name, which might save you a bit of money because you're only paying the $50 or $60 every 5 years to use that name. But to legally change the name, it is a bit more expensive to file that.
Right, so a question just came in. If a foreign company helps you to acquire a foreign client, can you claim the part of income you earn and pay to your foreign partner as a business expense? So this goes back to that question of whether or not we can substantially justify that was that cost incurred to earn income. And in this case, I would say yes. If you didn't pay that foreign company, you wouldn't have got that client and that revenue. So yes, you can claim those foreign expenses against that foreign income.
Fantastic. Lots of great questions today. So thank you everyone for your participation and for engaging in lots of wonderful questions that I'm sure many on the presentation also had as well. I just want to quickly wrap up because we are at 12 o'clock and I want to be mindful of everyone's schedules. Thank you again to MNP for this great session. Thanks Jacob and Tushar for sharing such valuable information with our clients. Just as a friendly reminder, we do have 2 more sessions coming up in this MNP Entrepreneurs Connect series. I know we touched on incorporating in the presentation. If you're looking for more information on incorporating the process and maybe diving a little bit deeper into some of those tax advantages and tax benefits, we do have a session coming up on incorporating your business. That's next Wednesday from 11 till 12. And then the last session in this series is on October the 28th. 11 till 12, same time, on CRA audits and how you can prepare for them. So lots of great content coming up in this final part of our Entrepreneurs Connect series for this fall. So I just want to thank you all once again. We will be following up this afternoon with a copy of the presentation as well as a link to the recording. So thank you again so much for joining us, and I hope everyone has a great day.
Thank you.
Thank you.